Hello. This is a video presentation on Chapter 3. We're using the PowerPoint slides and talking about some performance measures from this chapter. The chapter is on financial statements, cash flows, and taxes, and we're starting on slide 15, which is on free cash flow. Free cash flow, FCF, and it's the equation for free cash flow. The definition: free cash flow is the amount of cash that could be withdrawn from the company without damaging the firm's ability to generate future cash flow. Okay, extra cash flow. If we take this amount of cash outside of the firm, right, then no damage is done. The firm is fine as on an ongoing basis. So what do we see here? Free cash flow is equal to the EBIT, 1 minus T, plus depreciation, minus capital expenditures times a change in net working capital. So this first bracket is cash inflow, right? EBIT and depreciation, this is cash inflow. The second bracket is cash outflow. So basically the question is our cash inflow exceeding our cash outflow? All right, and in this equation we've applied it to the case that carries through the PowerPoint slides. You'll notice that we have a negative free cash flow. Well, that's a bad thing. Is negative free cash flow always a bad sign? You know, it's not a good sign. However, this is when it is a good sign. You know, generally you want free cash flow. Free cash flow is a positive thing. It's good when it's positive. However, if it's a growing firm, they are reinvesting a lot of money in the firm, and their capital expenditures and the change or the increases in their working capital could be high. In that case, these expenditures are high, and you could end up with a negative free cash flow even though the firm is healthy and growing. So although generally we want a positive free cash flow, there are some situations where a negative free cash flow is not necessarily detrimental. All right, and on to the next slide. Another measure of performance. Actually, two. Performance measures for evaluating managers. Accounting statements are insufficient for evaluating managers' performance because they do not reflect market performance. So MVA, right, measures the market value of the firm. We look at the current stock price times the number of shares, gives us the total market value of assets, and then we subtract from that the book value. This gives us some measure of the marginal value or the gain in the market value of the firm. Going on to the next slide, we actually have a little bit of a calculation. So this is market value in 11, market value in 12, and it shows in this case we have a substantial market value loss. Shareholder wealth has been destroyed, so whatever changes took place over that year were bad for the shareholder and were just bad overall. Let's go back to EVA. EVA is an estimate of a business's true economic profit, and here's the equation for that. Again, it's pretty much an accounting-based measure of performance. The distinction is this is what's in the bracket here. We have capital times the cost of capital. So the quantity of capital times the rate of expense on the capital. So we take our measure of income and we subtract from that the amount that we need to pay our shareholders. So this is distinct. It's a better measure than a simple net profit. If EVA is positive, then the after-tax operating income is greater than the cost of capital needed to produce that income. A positive EVA on an annual basis helps to ensure that the MVA is positive. The MVA is applicable to the entire firm, while the EVA can be calculated on a divisional basis. So those are three useful measures. You'll see them throughout the exams, the practice problems, and the homework. So I hope this was useful. If you have any questions, please send me an email or post a question on the discussion board. Thanks very much.